Welcome to the Traders Clinic, your regular shot in the arm of trader insights, philosophy and knowledge, brought to you by two professional money managers, Ali Crooks and Charlie Burton.
In every episode, we go through some of your burning trading questions and cover all things from the world of trading. Welcome back, mate.
Yeah, it's been a long time. We say that every time we come back for a second episode.
There we go.
Okay. So, yeah, well, we got this.
So this is an interesting one. So this was a question posed to two of us, and I thought it would make for quite a good discussion. So the question was around, what was your best trading period? But I thought we could elaborate on that and actually talk about what was your best trading period and what was your worst trading period, or at least a time where you can remember where things were going really well and a time when things weren't going quite as well.
Yeah. Do you want to go first? Or no, I'm going to put it to you. Okay. It's funny, isn't it? Because if I'd have been asked that question 10 years ago, I would have obviously given a different answer. We can only give an answer based on where we are now, 20 odd years into our trading.
Yeah.
And so it's always going to change. The answer, if I get asked this question in 5 years' time, it might be different again.
Yeah.
But as of today, I could cherry pick a couple, I'm going to cherry pick a couple. But let's start off with, I'll start off with the best trading period. And there's a couple I could pick, but there's a lot that went on then. So I'll pick the euro dollar.
Blimey,
right? The period from January 2017 to about July of 2017. That was the trade that I was in, or trading period, and I was in and out of this euro. I think what was fascinating with that was it was multifaceted. So it was a technical trade in that January of 2017. So it was a long euro dollar. The euro dollar had come down to about 103 and a half or so at that time. From a sentiment perspective, everybody was expecting the euro to go to parity. So there was a huge weight of expectation for euro to come down to parity against the dollar at that stage as well. And fundamentally, it was looking like the sick puppy, of course, at that stage. And yet there was multiple technical setups coming through. And like I said, we had extremes in sentiment. I was being interviewed in this, or in the former studio to this one that we're sitting in right now. And the interviewer was asking me about the markets and assuming, and every question was like, well, look, we all know the euro is going to go to parity right now, sort of thing. And I was getting that sort of interview at that stage. So from a sentiment perspective, it was screaming at me as an extreme. But the interesting thing was, in my stomach, I still didn't want to do it because it was effectively counter trend. It was some big divergences going on at that stage, technically in the markets. But even in your stomach, even though you've got, from a sentiment perspective, it's screaming, oh my God, this could be very saturated here as far as everyone's expecting to go lower. But even myself, I was consciously expecting the euro to go lower because, look at what's going on with it right now. And yet, from a mechanical trading approach perspective, I knew that I had to take the long side. And the fundamentals are never going to marry up at that moment in time. They catch up months later with what's going on at that moment in time. So I think one thing is important to stress is that it's never the easy trade. Most of the time, the best trades are the hardest ones in that moment to take. So when early January of 2017, and I was trading in and out a little bit, but holding a core position and then trading around that core position right up until I think it was, and it was nowhere near did I come out right at the highs by any stretch, but it was still a good, it was 1,000 pip or so run that I was trading through. And I think that's why that one, I'll always remember that one because there was multifaceted.
Mm-hmm.
Then you fast forward, funny enough, after that great, that great trade there, and I was still carrying on trading euro post that period. But then we get into 2018. I'm now 20 years or so into my trading, and the autumn of 2018 was the beginning of my longest, certainly deepest drawdown period. Now, that drawdown period was about 7 months from peak to trough, as far as my accounts were concerned. So I troughed in the April. So my account equity bottomed in the April, and then I came out of the drawdown period. But I'd got to a point where I'd reduced my position size. And so, of course, as I'm trading out of the drawdown period, I'm still trading on a reduced position size. So it took me until the December to then get back to prior peak equity. So in fact, it's taken me 14 months from the beginning of that drawdown to then get back to new equity highs. But did it matter to me? No, because that's my pension money, that's my it's my pot of money. I'm not in a rush to try and get it back. And so maybe we'll talk about that. So I could have upped my position size, but I was quite content just letting it just pick up as we went through that year. I'd gone for a 7-month drawdown, and I'm like, no, I'm just going to take my time with this and just let it happen. I'm not in a rush to do it. And then, of course, so I've gone from the April of 2019 through till the end. So a multi-month winning streak, and then into 2020, which was a fabulous year. 21 was a great year. 22 was a great year. So you never know what's coming next. And so although you get these drawdowns, but I think just to wrap up, it just goes to show you can be 20 years into your trading and have your biggest ever drawdown.
Well, I think that was the thing I was going to highlight. I think it's really important for the people listening that's the method. I think if there was one thing to take away from that, it would be that, because I think there's this illusion that, I'll get 5 years down the line and drawdowns will be a thing of the past, or people logically know they're still going to have losing trades, but they think on some level, they think that, drawdowns are for the inexperienced traders. And that's a huge thing, I think, that people take away. But I wanted to ask one question on that, because I think it will be a question that people listening will potentially be answering.
How much?
No, how much? I don't think that matters, but I was curious. You talked about reducing your position size. Was that a conscious a reaction decision to the fact that you were in this drawdown, or was that, did you have a rule in place that says if I reach a certain level of drawdown, at that point I reduce my position size? So was it more of an organic decision or something that was very, very rules based?
No, it was very organic. I don't have a rule that, okay, I've hit 10% drawdown, therefore I'm going to do this, isn't this? To me, it's more than that, because I'm trying to get an assessment of the markets that I'm trading. So I was trading euro dollar food, and there was euro dollar. Fun enough, the euro dollar. If anyone wants to have a look, you look at the weekly time frame of euro dollar from that autumn of 2018 into comfortably into like the spring of 2019, and it was just like up 1 week, down one, the following. So it was just chopping, So I'm going to make my decision based on what I'm seeing in the charts, not based on that I've hit a given level per se. But at the same time, I knew, I've been trading through this whole chop as it's turned out. I need to now, reduce my position size. I'm not going to carry on and turn a 10% drawdown into a 20% or whatever. So no, it wasn't. It's not rules based, because I don't trade rules based in that way. But certainly I think it's an important thing. And this is the one thing that I think a lot of people come back to. But if you by the time you got to June, Charlie, why didn't you just change your position size back? Absolutely, I could have done. But I'm quite a relaxed trader. And I think, if I'd have been really committed to wanting to get on with getting to new equity highs again, then I could have done. Once I'd got a couple of 2 or 3 months of steady gains under my belt, then maybe I should have done it sooner. I guess shoulda, woulda, coulda, but I wasn't bothered, and I was quite comfortable just carrying on trading that way. So if anyone says, why didn't you? There's not a specific reason why I couldn't have gone back to the prior position size a bit sooner and therefore got to new equity highs sooner, but I'm not in a hurry. You know, it's not going anywhere. I'm trading for the long term, not for what happens next month.
Great. So,
Right, over to you then.
So I think there's two recent periods. When we thought about this question, I struggled a bit because there's certain periods of your trading career become a little bit of a blur. I can't specifically remember a time. I'm sure if you asked me 10 years ago, when I was doing more day trading, there was sweet spots within that if you were asking me that question then, I'd be saying that. I think the two that come to mind was a period in 2019 where I had about 5 months where it felt like, I mean, if I went back and actually looked at every single trade data, there were losing trades in there, but it felt like I went through that period that everything I did just worked. So I'd be trading, I'd be in a with the trend position, running that up, get out, then I'd have a counter trend opportunity. I take that, it would work. So it was a period for about 5 months where the statistics were skewed way over in my favor, and I was having way more winning trades than I should have. And I think the reason why I think that's an important period is not so much about the winning run for me, it's about understanding that even at that point, I think if I'd been a trader with 2 or 3 years experience, I would have got into a position where I'd have been thinking that I somehow knew something that other people didn't, or would have been overly confident. And all I can remember about that period is just I kept saying, this is going to end soon.
Yeah.
It's going to end soon. I remember saying it to traders that I spoke to, this is going to end, this isn't going to happen. And I think the lesson I wanted to pass on to people listening is that I wasn't doing anything different during that period. There wasn't a secret sauce, there wasn't some sort of information, or I wasn't performing better. I was just executing the same way, and it just was for that 5 months, 2019, it hooked up. Ironically, just around that period of time, I decided that was when I was going to set up my own fund, and then of course things died off a little bit. So I think that's that. I remember that period not because of so much the result. Yes, the result was nice. I had a massive uptick in equity, but it was the fact that I was saying, this isn't about me. This is just about the system that I'm trading performing really well.
We're going to talk a little bit about that when you just said massive uptick in equity in the next subject as in a bit.
Yes.
But okay, so I think that's fascinating. Just again, as a reminder to people that you're going to have these good spells. It's not necessarily always something you're doing differently. It's just that your strategy, your approach, plus the market is moving in a given way, which it all comes in synergy.
Yeah.
And they're not always doing it. They're a bit more, like you said, it could just be, like you said, your stats were that it felt like you were having winner. And so over a longer period, that win rate may drop off a bit more and be more in line with what it historically has made. But of course, we're always going to have those condensed periods, which are amazing. So go on then, let's have the opposite of that then.
I would say it's fairly recent. It was 2021, and it was the first half of the year. And again, it wasn't a massive drawdown, but it was an extended period of time where the opposite was happening. No matter what I did, I was doing the same thing, but it wasn't working. So it was about 5 months. And I can actually remember it because we met up socially. We went down to Cornwall, and I remember we chatting, you're like, how's things going? I can't catch a cold at the moment. I remember saying that to you because whatever I'm doing wasn't working. But then interestingly, it was right at the point where even I could start to look at what I'm doing. Is there something I'm missing? And I found that that's actually, ironically, the cue is when those questions start coming up, is then I had it was a short winning spell, but I made up, if you looked at my performance, my 6-month performance on average, I made up for those poor 5 months within, I think it was 6.5, 7 weeks. So I was back at my average. So it wasn't a huge drawdown, but it was a period of just continual, I'm firing into trades as I normally would, I'm doing everything right, and it just wasn't happening. And I remember speaking to other traders who were having actually a really good time. And I think that was the other lesson is I didn't jump ship and start trading something different just because trader B and trader C are killing it doing something different. I was like, no. But as I got into month 5, I could find myself questioning what I was doing. And it's in those moments where I think you have to really believe in what you do. Not when you've had a couple of weeks where it hasn't worked. Yes, there's been other periods. I can remember when I first started out. I mean, they were just, the suicide, I call them the suicide missions, where you don't really know what you're doing. But I think that's more relevant for the traders out there. It's not always necessarily a big drawdown. It's, a sticky period. I'm talking about 5 months. You were talking about the best part of, 8-9 months, over 14 months. I think sometimes there'd be traders out there who'd be quite shocked that we're talking about these time periods. That in their mind, a drawdown lasts a week or maybe a month. And I think that's the lesson people could take away, that some of these periods aren't as short as they might think.
Well, on that note, that gives us a beautiful segue directly into this next subject, which is about looking at a 10-year period. So a lot of traders, like you've just said, they measure themselves and they look at, well, a drawdown shouldn't ever last anything longer than a week or a month, let's say.
Yeah.
And let alone maybe a quarter. But actually, let's look at, a 10-year period and for any successful trader. And let's actually have a look at the realities of a 10-year period, because it comes back down to what we're talking about just here. Also for a lot of the traders out there who have certain expectations about performance. So,
I think one of the things about thinking in bigger, what I call bigger time and space horizons, is a trader can listen to that and they can go, well, logically that makes sense. Yeah, over a 10-year period, you might have a year where you don't make money. You might have 2 years, and you might have 2 years where you make, if you extrapolate it out, 2 years where you make really big returns, 2 years where you have losses, and then the rest of it, the other batch of 6 years are sort of in the middle. And people can logically acknowledge that, but the ability to be able to transfer that logical understanding into week by week, month by month, and having that acceptance, because it's one thing saying, okay, I might not make any money for 6 months, but it's another thing being able to be okay with that when you're in the 6 months. 6 months is a long time for any trader, and I think that's where the skill and resilience it needs to be built up, is the ability to go, okay, I get what you're saying about 10-year periods, Ali, but I've got to be able to deal with that over the shorter term time frame.
It's exactly the same as when you talk to a trader about win rate. So you say, okay, you've got a 50% win rate. Well, that means you're losing 50% of the time. Logically, they understand that. Logically, they're like, okay, 50% win rate, 1 to 2 risk reward, you're making money. Right, okay. And then you put them into that, and then they're losing money 50% of the time. Oh, like you said, all of a sudden they don't like that, And it's the same with what you've just said there. So this was written about by a highly successful trader, this 10-year thing, where he said, you could. It's not a definite that you're going to have a losing year,
no.
But you could reasonably expect it to happen over a 10-year period. It's a bit like coming back to win rate. That if you've got a win rate of, let's say, 50%, well, you do enough trades and a run of 10 losers in a row or more is likely to happen. And again, logically, we understand that. We just don't like it when it happens. Logically, like you just said, like I've just said, when reflecting on what you'd already said, over 10 years, is it reasonable to assume that you could have, as a trader, a year, maybe even 2 years out of that whole 10 years, and you could be highly profitable? We're talking about solid trader here, a really profitable trader, and yet he still had 2 losing years out of 10. He had a few flat years and 2 or 3, whatever it was, mega years, maybe 4. So, and at the end of the 10-year period, he's highly, highly successful, highly profitable. And yet you go out there to your average retail trader and they'll be like, no, I don't want that.
They want the paycheck. What would you rather? 1,000% in that 10-year period, but have to have 2 losing years, or 500%, but you're making it steady. You're a steady Eddie. I think most people want a more predictable basis to it. But the problem is that even within those periods of time. So let's say you've got one of those uber profitable years. That doesn't necessarily mean that profitable year was profitable for the entire year. There might have been 2 months in that profitable year where they weren't making any money, but it was 10 of those months where it went really well. So you've got the dynamic of how each of those years plays out. You could have had one of those losing years where for 6 months you were up, and then the 6 months is where you gave it back. So you've got all of these things going on, and I think a trader is fighting against that the random nature of what happens short term versus the profitability over the long term.
And I think that's why we've shared our experiences of drawdowns and really, really profitable periods as well, just for that very reason. We're just reflecting on this whole 10-year, when you take a step back and what highly successful traders can achieve over a longer period, and the fact they can have these periods of losses as well. That we've just talked about some losing periods as well, just cherry picked some losing periods, as well as some really strong, solid periods as well. When you really take a step back, that is the way it is. Unfortunately, like in many aspects in the world, it's the old 80-20 rule. In trading, you'll get 80% of your gains from probably about 20% of the activity. That's the way it is. And the rest of the time, there's chop, losing periods, and whatever. But you'll get the bulk of your returns from a smaller cluster of time, so to speak. And if you keep that at the back of your mind, rather than thinking that you have to be profitable 12 months out of 12, then it will help you to deal with the knockbacks, because the better traders are the ones who deal with all the stuff the market throws at you, the drawdowns, losing periods, and all of that. Those are the ones that are around in 10 years' time. It's the ones who are hoping to be profitable day in, day out, month in, month out, usually the ones who aren't around in 10 years' time, because their expectations are way above what is deliverable.
Like that. I think that is a great way to end.
Okay, then, on that note, his name's Ali Crooks.
His name's Charlie Burton.
Trade safe out there.